Please, baby, come on home.
Hey everybody, welcome back to another week of Teaching Thursdays. We want to welcome you. We're going to touch on a topic that many people don't know too much about, but they've probably heard of the term before, and that's going to be commodities. So we're going to start off with what is a commodity. Now, a commodity is simply a basic good that's going to be used in the exchanging of goods and services. So, you're going to have raw materials such as oil or, oil, corn, wheat, metals, things like that, so on and so forth. And so the exchanging of these items between one entity to another is going to be known as commerce. So for example, let's say Starbucks, who's selling coffee to a customer. Well, the coffee is going to be the commodity, but the exchange of the coffee from Starbucks with the money from the customer is going to be what is known as commerce. Now, this is something that just happens all the time, heavy transactions, and normally, commodities are going to be dealt with bigger businesses and corporations. So like we mentioned, the Starbucks. We're going to get into an example with Kroger later on about buying commodities for the grocery stores from a farmer. So next up, who can own commodities? Well, anyone can own commodities, but usually they're left to the bigger corporations. So a Starbucks or a Kroger, they're usually going to buy commodities from like a farmer or anyone that's growing these items or that has supply of these items. So if it's oil, they're going to buy from an oil company, so on and so forth. Usually people like ourselves aren't going to have any use for some of these items except something like gold. People might keep gold in their house in a safety deposit box, something like that. So next up, where are commodities located? Well, the raw material commodities, of course, are going to be located in certain areas. So, the corn, the wheat, those are going to be, supplied by a farmer on a farm, and oil is going to be supplied by an oil field, and metals are going to get from those places. But in terms of actual commodities for investing, those are going to be in a commodities market, and they're usually sold in the form of a futures contract. And we're going to get into what a futures contract is between one entity and another in terms of investing. So now in that next topic, we're going to say, how are commodities traded? Well, let's say, for example, Kroger grocery store wants to buy corn from a farm, and there's going to be a farmer. So you're going to have one entity, which is the farmer, and you're going to have the other entity, which is Kroger. So the farmer is selling, a bushel of corn for $5, and Kroger says, you know what, we need 5,000 bushels of corn. Well, if Kroger needs 5,000 bushels of corn and it's going to cost $5 for each bushel, that's going to cost Kroger 25 racks to get that corn into the grocery store. So that's why when you think about that price point, oil is like $50-something a barrel, but at one point it was $100-something a barrel. But like when you think about these numbers, like who's really trying to spend 25 grand on corn or wheat, coffee, things of these natures? There's everyday people like us. So that's why when I mentioned that commodities aren't really for retail investors, and when I say retail investors, I mean people like yourself and me. That's just kind of how it is. So back to the example. Now, Kroger needs that. They're going to buy it in the form of a futures contract. Now, this future contract means that Kroger and the farmer are going to make this deal, but it's going to be fulfilled in the future. So let's say the farmer is growing the corn from like April to June, and they're actually going to, be ready to sell come September and October. Well, Kroger is going to buy a futures contract from the farmer, and they're going to say, you know what, we need those 5,000 bushels of corn for 25 grand. We're going to seal the deal, but it's going to complete in the fall. So the deal is going to be made in the summertime, but it's going to complete in the fall. And Kroger is going to pay that 25 grand, and now the farmer has to own up to the deal. Now, this is where this gets a little bit tricky is that, let's say the price of corn goes up by the time the fall comes around. Well, the farmer is set in the money, so the farmer is actually going to lose out on money because they could have sold it for a higher price, but they would have had to wait it. And the same goes for the opposite. If the corn would be decreasing price, and the farmer is actually going to make more money than if they had waited to sell it. However, the farmer is going to make $25,000 regardless, so that's at least a set amount of fund or fixed income, which is something similar to a bond where you're going to get a fixed rate and earn money back in the coupon. Check out that video on bonds to find out exactly what a coupon is if you haven't seen it. Now on the flip side for Kroger's locked in for the deal for 25 grand. So if the price of corn goes up, Kroger's winning. If the price of corn goes down, then Kroger lost. But either way, they got the deal from the farmer, so they're going to be set, and they're locked in for that price. So in essence, that's kind of how a future contract works, and particularly in the commodities market. Now, when can you invest in the commodities market? Well, commodities are actually going to be timed based on what the commodity is. So you want to check out CME Group. That's www.cmegroup.com. There's other websites, but that's one that I've checked out for myself. And you can actually look up, corn and gold, things of that nature, and see what times that these items are being sold between when it opens, when it closes. And you can also find the prices of these items as well. Honestly though, like I mentioned, retail investors aren't really going to be dabbling into it. So, you're not really going to be looking for it the same place that you're going to look for Apple stock, or the same place that you're going to look for a municipal bond. The commodities market is going to be something separate on its own. Now lastly, why should you invest in commodities? Well, I mentioned earlier about people like us really aren't going to invest in commodities, but if you're interested in that kind of thing, by all means, do what you do. If you have a corporation, let's say you want to start a grocery store, or, you want to start up a coffee shop, then things like these commodities are going to come, they're going to be a part of your overhead, and so dealing in the commodities market might be beneficial to you. But if you're, just an everyday Joe, you're going to work, let's say you work for Time Warner, you don't really have a need to be buying barrels of oil or bushels of corn, so the commodities market might not be your forte. However, I advise that you look more into it and see if it is something that interests you, and maybe you might be able to make a few dollars off of it. Thanks for tuning in to this week's Teaching Thursdays. We hope it's been educational and beneficial. Continue to tune in each and every Thursday to make sure that you get exactly what you need. Make sure that you're learning the basics. We're giving you the who, what, where, when, why, and how, and making sure we're addressing all these topics. Check out today's 10 apps in 10 days post. We're talking about capital. We've already talked about acorns, betterment, and drive wealth. Today we're talking about capital, which is actually kind of like a DraftKings in the stock market. So, go ahead and check that video out. Get an idea of how the app works and what the company is all about. Peace.